Hi, and welcome to the Day Trading for Beginners podcast. This is episode 27. And in this episode, we're talking volume analysis for beginners. So this is going to be very much an introduction to volume. Now, in the previous episode, we talked about technical indicators, and we actually talked about three of them. And, looking back on that episode, I don't think it was that effective in really, having a audio format here as a podcast to discuss those technical indicators. So in this episode, we are going to talk about volume, sort of an introduction to this idea of volume in trading. And then we are going to talk about just one specific indicator. However, I would recommend that in the show notes, you go check out the video version of this podcast because then you can get a visual kind of lesson and interpretation of the indicator. So again, we're going to talk about it. We talked about three in the last episode. I don't know how effective that was, so I apologize for that if it was sort of not that effective. Here, we're going to talk more about volume analysis. And then, I would recommend that you certainly check out some other resources like the YouTube channel for any visuals in terms of seeing these indicators on a specific chart. Okay, so let's get into it. Volume analysis. Again, we're on a journey here to become full-time day traders. We are at the stage where we're studying technical analysis and we're sort of in the beginning stages. We talked about indicators in the last episode. We've talked about, support and resistance, that idea. We talked about, what technical analysis is and candlestick charts. And now we are on this subject of volume. So if you'd like to download my 6-month blueprint, that will outline everything that I'm doing in the first 6 months. And then if you actually do that, once I have completed the 6 months, I'm going to send out an updated version that has all the resources that I've personally been using to study all of this stuff. So certainly this podcast is great, but you probably need to go out and watch some videos, reference some articles, and I will have everything that I've personally used in that blueprint. So you can go to stokestrades.com/blueprint to download that for free. So volume analysis. Okay. So when it comes to day trading, if you're listening up until this point, I think that even as a beginner, we can understand that, price movements is really crucial for how we're going to make trading decisions. So that's that idea of price action. You're watching the candlestick charts, and what price is doing is going to help you dictate what you are going to do in terms of placing a trade to buy or sell whatever security you are looking at. But, what if I told you that there's another crucial factor that you need to consider to make even better trading decisions? Imagine having an additional tool that can help you confirm trends, identify potential reversals, and gauge the strength of price movements. Well, this tool is volume. So in this podcast, we're going to sort of get introduced to just the basics of volume and how it can enhance our trading. And we're going to focus on just one technical indicator, and that is called the volume weighted average price, or the VWAP. And we're going to just discuss the formula in detail so we can kind of get a good idea of what actually goes into the formula, and then talk about, how it is used a little bit as well. So, when you think of volume, or at least when I'm sort of starting this journey, and I've been studying technical analysis for a little bit, I can understand that watching the price of the stock is going to be key for trading decisions, but I never really thought about volume. But it's certainly, now that I've reviewed it, it makes sense how the volume of shares and the volume of buying and selling is also going to really play a role in where price is going to go. So volume, it refers to the number of shares traded in a market during a given period. So it is a fundamental metric in trading that indicates the activity level of a stock. So high volume means, more traders are active, while low volume indicates fewer traders. So, why is volume important? Well, it's crucial because it shows the level of interest in a stock, for example. So high volume often means higher liquidity, which can lead to more stable price movement. So the more liquid a stock is, the more that you can, buy or sell at a price that's listed, and you sort of get that price when your trade gets executed. So on the other hand, low volume can lead to more volatility and price slippage. So if you wanted to execute a trade at $100, but it doesn't get executed, it gets executed at 101, that's some price slippage. Now, I am aware that, low volatility markets can be good for certain day trading strategies, but certainly, good volume and good liquidity is also crucial for certain trading strategies as well. Now, in terms of, volume and price, what's the relationship? Well, they are closely linked. And again, when you're first studying this, you probably or personally, I didn't even really think of the volume, but it is linked to the price, because when a stock experiences high trading volume, it generally means that there is strong interest, which can drive up the price or drive down the price even more with more significance. So low volume, that might suggest that the price movement lacks any conviction and it may not be sustainable. Now, there is this sort of belief in the technical analysis world that volume actually precedes price changes. So what this means is that significant changes in volume can often be a leading indicator of future price movement. So for instance, a sudden spike in volume might indicate that a substantial price move is imminent, as increased trading activity sort of reflects the heightened interest or sentiment in the market. So just in general, studying volume is key in keeping a track of it. All successful traders do this. So there's sort of like a significance with, high and low volume days. You got a high volume days. These days are often sort of coincide with significant price moves, and they can be indicators of strong market sentiment. So a strong sort of mood of the market. And these can also confirm the strength of a trend. So if a trend is moving up and there's a lot of volume behind it, there's a lot of trading activity, that can kind of confirm that that's a strong trend and it could potentially keep going up. And then, on low volume days, these can sometimes indicate, just a lack of interest or sometimes uncertainty in the market and can lead to weaker price movements. And, low volume can sometimes suggest that the trend might not be strong and actually it could reverse. So if we kind of talk, about that point in a little bit more detail, just some practical applications of, volume analysis, one is just confirming trends. So volume can validate price trends. So a strong uptrend, again, with increasing volume, it's more likely to continue than one with declining volume. And just knowing that when you're trading is certainly important. If there's a trend up that you recognize and the volume is there and it's increasing, then, the probability of it to continue is probably, good, is probably high. So volume, again, it can confirm the strength of a price breakout also from a resistance level. So if the price has met resistance and perhaps it's broken through, we talked about that resistance level in our support and resistance episode. So if there's a resistance level and, for all the factors that come into it, that the price has broken that resistance level. So there's price and then there's people, that were expecting a reversal and they short, now they need to cover, or people that sold early, now they want to jump back in. If there's large amounts of volume, so there's a lot of traders in that initial breakout from the resistance, that could be an indication that it's going to take off and it's going to actually confirm the breakout. Now, you can also sort of identify reversals as well. So changes in volume can signal potential reversal. So, for example, a downtrend with decreasing volume, that might indicate that a reverse is going to happen if the volume suddenly spikes on a specific day. So, if you've got a downtrend and then the volume is low and low, and then, you've got an uptrend or, one day where it turns positive and there's a lot of volume that comes in, that could identify that a reversal might be happening. So that's like that divergence. If you look for divergence between price and volume, so divergence is the difference there. So, if price is making new highs, but the volume is decreasing, then that might be an indication that, there might be a reversal off those new highs. So again, these are all the things, all the ways that volume plays a role in trading. Now, in terms of indicators, we talked about technical indicators in our last episode. And, just to think about that, the way I sort of think about it is just, a technical indicator, it's a tool, it's often a formula, and basically it takes raw data of the price action of a stock, and it just creates a visual representation that's going to allow you to make trading decisions. So in terms of volume indicators, there's this one called the VWAP, and it seems to be quite popular. It stands for volume weighted average price. So it's an indicator that's used by traders, especially day traders, to determine the average price a stock is traded throughout the day based on volume and price. So in the show notes, you can access an article that has this formula written down. I have an image of it, and I have a nice table that you can access to kind of go through it. So I'll just kind of talk through it here so we can get a clear sort of understanding of what this is. So the VWAP is basically the sum of the price times the volume at a given time divided by the sum of all the volume. So what it represents is the average price a security has traded at throughout the day based both on volume and on price. So the formula, basically what it does is it multiplies the price by the volume for each trade during a specific trading session, like a day, and then it sums these up, and then you divide by the total volume for that entire day. And what this gives you is the average price at which the security was traded, weighted by the volume of each trade. So instead of just getting an average of the trade for a specific timeline, you're going to take volume into account. And basically what that means is that the more volume a specific price of the stock was traded at during that day, then that's going to affect the average of this formula, the VWAP. That's going to affect it. So it takes into account the volume also of the trades that are happening. So we'll run through an example here, but just know that what that basically means is that if there is trades that happen that have a very low price with high volume, then you can expect that the average is going to be swayed to the lower end. And then if certain trades come in on a specific period, like the end of the day, and the stock has spiked up, and there was lots of volume near the end of the day as the stock rose, then the VWAP, the average price, is going to be swayed to be higher because there's more volume at that higher price. So if you sort of just run through a really basic example, if we just kind of broke this down to really, really simple terms, and we just said that there is just a time interval of just 3. So let's pretend this stock is just traded 3 times throughout the day. So the first trade happens when the stock's at $100, and let's say 200 shares were traded. And then the very next time it is traded at $102, and there's 150 shares traded. And then the last time it was traded, it was maybe traded at 101 for 250 shares traded for that price. So what you do is basically you multiply all those up, and then you add them together, and then you divide by the total share. So there were 600 shares traded in that scenario. And when we multiply those and add them up, it equals 6,000 or 60,550. And basically the calculated VWAP there equals $100.92. So basically that just averages it out. Out of those 200 trades at $100, 150 trades at 102, and then 250 trades at 101, the average there, the average price for those 3 trades is $100.92. And basically in real life, the VWAP is going to calculate all the trades in that given period. So this example, we just looked at 3, but on a real life situation, there's going to be potentially millions of trades throughout a day for a very liquid stock, a high volume stock. And basically it's going to just calculate every single trade, every price, and every amount, and then divide it by all the volume. And that's basically what this indicator does. So if you sort of went through this and you did, an exaggerated example there. So, for that one, we ended up with $100.92. Now, if we pretend that, in that first interval, that first stock price of $100, instead of 200 shares, there's maybe 2,000, that's going to sway the number and it comes out to be $100.23. So again, volume is affecting this VWAP, this volume weighted average price. So that's basically the formula, and basically what it represents. It's pretty straightforward here. What it gives traders is an idea of basically the average price at which the stock has been trading throughout the day, and it considers the price and the volume. So it helps in comparing the current price of the stock to the VWAP to determine, the market's trend. So, if you're looking at a stock chart and you have the VWAP on there as one of your indicators, and you notice that the stock price is above the VWAP, that indicates a bullish trend is happening on this specific day because the stock is above the, weighted, volume weighted average price. And then again, if it's below the VWAP, then that stock price is below that. That could be indicating that, you've got a bearish little trend happening throughout that day. So keep in mind what this VWAP is. It's a cumulative indicator, meaning that it's recalculated throughout the trading day, giving an updated value, as more data comes in as the trading day is happening. So this makes it like a dynamic and highly responsive indicator, which is good for people who are day trading, doing sort of intraday trading. So if we kind of think about this indicator, just the VWAP, the volume weighted average price, and then you think back to what we talked about in the last episode, just a standard or a simple moving average, they are similar but different as well. So in terms of considerations there, the VWAP, it takes into account, again, this is a summary, it takes into account the price and the volume. So it multiplies the price of each trade by the volume of that trade, and it adds all those up and then divides by the total volume for the day. And this makes this VWAP a more accurate reflection of the average price at which the stock has traded throughout the day, because it weighs in the volume in each trade. And then a simple moving average, if we remember back from the previous episode here, that considers only the price. Generally, it's the closing price, and it calculates the average of a stock's prices over a specific number of periods, giving equal weight to each price point, regardless of the volume traded. And there is, exponential moving average, which, has a formula that rearranges it a bit to make the most recent prices more predominant in that formula. But, a simple moving average, that's what it is. It's a equal weight, a price point that doesn't take volume into account. And in terms of, how it's calculated in terms of its period, the VWAP resets at the beginning of each trading day. So it makes it particularly useful for day traders. It provides traders with sort of a benchmark price for the current trading session. And again, a moving average, it's calculated over many periods. We had the 5-day moving average. We talked about the 20-day moving average, the 50-day and the 200-day moving averages. These are really popular ones. Basically, what these do is they make this moving average a versatile for analyzing sort of long-term trends and smoothing out the price data over days, weeks, or months. And they have the role in your trading strategy as well, or they potentially will. So that's sort of the two periods. Now there is this thing called a anchored VWAP, and we're not going to get into it too much in this episode. In future videos, we might talk about this and do a demonstration. But unlike a standard VWAP, the anchored VWAP, that can be applied over a longer time frame because it doesn't reset daily. Instead, what you can do is you can select a specific starting point, such as a specific date like the new year, or maybe there was an earnings call, and basically it calculates the volume weighted average price from that point onward. So if you want to look back and if Nvidia or Apple or whatever stock you're tracking had an earnings report that came out on a certain day, where you can put your anchored VWAP on that day, and then you can look forward and then measure the weighted the volume weighted average price from that specific time. So this makes this anchored VWAP useful for analyzing long-term trends and key price levels over, days or weeks or even months. Whereas the standard, VWAP sort of is more of an intraday, more of a daily kind of indicator. So in terms of usage and application of both the VWAP and just a standard move or simple moving average, the VWAP, again, primarily used by intraday traders, so day traders, and institutional investors to sort of gauge the average price of a stock throughout the day, helping to determine sort of the optimal entry and exit points. And this sort of, it's done to ensure that trades are executed at a price that reflects the day's sort of average activity. So that's sort of how that is used, sort of like a broad definition there. And then a moving average used by traders and investors to identify overall trends, support and resistance levels, and to sort of smooth out the price of fluctuation. So it's more of a fundamental tool for spotting sort of long-term trends and maybe potential reversals. And again, there's strategies where moving averages cross over and so on. So there's ways to dive deeper into each of these indicators. But sort of in summary, in regards to comparing them, the VWAP gives a more detailed intraday analysis by incorporating volume, making it very useful for day traders. And then a moving average, a simple moving average, just by averaging prices over longer periods without considering volume, it's better suited for identifying sort of long-term trends and smoother price movements. But again, both indicators, they're powerful when used correctly within your strategy, and they serve sort of different analytical needs in trading, but certainly ones that we want to get familiar with as we're getting ready to become full-time day traders and we're studying this and so on. So just sort of wrap up this sort of shorter episode here on volume. Basically, understanding volume and its indicators, it's crucial. It's very important for us aspiring day traders. Volume provides insights into the level of interest and activity in a stock. And when combined with price action, it can, validate trends and potential reversals and could really help making your entry and exit moves as you're day trading or trading stocks and other, securities as well. So talking Forex currency pairs. So the volume would be the pairs that are traded, just like the stock that's traded when we're talking stocks. And again, that VWAP, that volume weighted average price, it's a powerful tool that helps traders understand the average price a stock is traded at throughout the day, weighted by volume. So again, unlike just a simple moving average, which only considers price over a specific period, that VWAP incorporates both the price and the volume, making it particularly useful for day trading if you're trading throughout a single day. And again, that VWAP resets at the beginning of each trading day, providing a dynamic and very accurate reflection of the day's trading activity. And then there is the anchored VWAP that you can use for longer periods. So sort of bottom line, volume and volume indicators, they're clearly something every day trader needs to fully understand and master. Here we talked about them in very much an introduction, basic beginner friendly discussion. But, there's textbooks on volume analysis. There are much more things that we can get into here, which we will in the future. But I thought this was a good sort of introduction to this subject matter. And again, on our community on school, where we have a course on technical analysis, it's all free information. I'm always going to update the course information with any good resources. So again, this is a podcast version. We're going to have a video version of this, but again, you probably want to potentially access some textbooks maybe, or access other good resources online, websites, and other videos. And again, everything I come across, I'm going to share in the resource section of all the free courses on school. So again, for access to that, it's free. You can just find that link in the show notes. So thanks so much for listening to today's episode. Subscribe to the podcast. Check out the show notes for other links to our other channels on YouTube and our free community on school. And I look forward to talking with you in the next episode.